We're still going to probably $300 to $500 silver, and probably much of that occurring by summer. Silver has all kinds of arguments for it, both technical and fundamental. And yes, we had a sharper pullback than gold just recently, but it's still outperforming gold. So we favor silver over gold, and we think this is a buying opportunity. If gold went to the 8,500, match the prior bull markets, and silver went to 3%. I mean, that's where it was in 2011. What's that, $240, $250? Look what happened when silver got up to 93 to 95 a couple weeks ago. If this were 6 months into the move, and if silver had reached $400 or $500 or something like that, I think you would have a sharp correction from there, but not back to $50. The old reality's gone. The issue is, did you get in at the proper time? And I think happens to be right now is the proper time. You've got to pull back, use the opportunity. Even the short-term stuff is saying, hey, I'm out of the hole. At that point, I would say, if you're not in silver, join in. Yeah, you're buying it off the low. Nothing has broken other than public sentiment.
The first one I want to dig into is the silver sector. And I've been long gold for the last 2 years, so that's worked out well. But I've had very little exposure to silver, and I think it just got away on me. It just went too far, too fast. And now we've had this nice pullback here. What are your thoughts? Is this a buying opportunity?
Yeah, I think so. All of our work from various vantage points, not just momentum structural analysis, but relative performance analysis of silver versus gold versus the S&P. In other words, what's the macro trend of the monetary metals? Okay, thumbs up across the board. Gold miners, gold, silver. Okay. Then within that asset category, silver is outperforming gold. Oh, yes, it got shin kicked in 1.5 days. That's how long that drop lasted, by the 1.5 days. Now, we spiked that out last week, I think on Friday or so. We spiked out that low, but it quickly came back up. But most of the drop was literally within hours.
The real story isn't the drop, it's how fast buyers step back in after it. Michael Oliver's momentum framing suggests silver's leadership versus gold, and the S&P is intact despite the volatility spike. A one-day decline doesn't erase relative strength trends that have been building since late 2024, especially while mining equities continue stabilizing. Investors should remember silver historically corrects violently even during strong bull phases, a pattern seen in multiple commodity cycles. Portfolio positioning matters more than short-term price swings when leadership shifts inside metals. Next, Michael Oliver's framework challenges the idea that sharp drops automatically signal market tops.
Okay. Now, people thought, that's it, it's over, done. You don't have that kind of drop without a top. Our work says no. You did not break anything except sentiment. Long-term momentum trend factors are not even near points of structural breakage. Whereas in the past, when we made tops, 2011, for example, or the low in 2015, there was ample structure on momentum where you could look at a momentum chart and say, oh boy, you break that line, you're going down. Oh boy, break that line, you're going up. We don't have any structure nearby. And whenever you do not have clear bridge over the River Kwai type structure to blow up, to break down through, you probably aren't at a top. Almost all tops, I'd say 95% of them, have clear momentum structures that when broken, then you later find out price joins in. Anyway, so the answer to that question, yes, silver got trounced. However, I think it is a buying opportunity for those who might not have been in the first move. And I think that we're still going to probably $300 to $500 silver this year. And probably much of that occurring by summer.
Market panic often confuses sentiment damage with structural damage. Michael Oliver is pointing out that prior silver tops, like 2011, showed clear technical breakdown signals before prices collapsed. Today's charts don't show that same momentum failure, which matters more than headlines about volatility. Investors should be cautious about price target excitement, especially when projections jump toward $300 to $500 within months. Commodity markets rarely move in straight lines without liquidity shocks or policy catalysts driving them. Next, Michael Oliver explains why historical market repricing events could reshape expectations for silver.
As crazy as that sounds, it is not crazy. There's many examples of other markets doing similar type repricing to a new reality type events. Silver has all kinds of arguments for it, both technical and fundamental, that favor that sort of rapid readjustment. So our assessment says, yes, full thumbs up. This is a buying opportunity. In our weekend report, we put out some defining numbers where if we get above certain numbers this week, for example, in silver or gold, it says, yeah, you better get back on board if you got out. So yeah, I think that's the prime event of the year right there coming up.
So once again, your new target on silver is $300 to $500 by sometime in the summer.
I cannot be any more precise, unfortunately. The tantrum type move that is, having lived in a half a century range between $4 and 50 back and forth for a half a century, while nothing else did hardly. Copper didn't live in a range that long. It lived in a similar range as silver did for 50 years.
Big price forecasts usually reveal more about market psychology than probability. Michael Oliver is arguing that silver could experience a repricing event, similar to commodities that break decades-long ranges after structural shifts. But investors should remember that copper's breakout cycles historically aligned with global growth surges and industrial demand expansions, not just technical signals. Rapid moves often depend on liquidity conditions, central bank policy direction, and real economy demand strength. Chasing breakout narratives without confirming macro support can increase portfolio risk significantly. Next, Michael Oliver connects long-term commodity range breakouts to past metal market transformations.
It remained in a range from the 70s, 80s, 90s, 2000 into about late 2005. Copper said, oh, I'm no longer going to live in a 50 cent to $1.50 a pound range, which is where it lived. Instead, in a couple of quarters, it went to $4.50. Bam. Okay. No particular nuclear reason for it. It wasn't in sync with gold or silver at that point. It wasn't even in sync with other base metals. It just said, I'm going to a new reality. A couple of years later, in 2007, lead did the precise same thing. Lived in a range for decades and decades. Said, oh, I'm out of here. Boom. Quadrupled in nearly a couple quarters. And if you look at gold, going back to when it was legalized 75, 50 years ago, it never stopped at its old highs. Made a high at $200 and went down, made a high at $850, went down, made a high at $1,200 almost, went down, and now we're, et cetera. So it wasn't confined in a 50-year box. Why was silver? Okay. Well, there's, explanations for that.
Commodity breakouts rarely happen without a macro catalyst hiding in plain sight. Michael Oliver compares silver's potential move to copper's surge after 2005. But that period coincided with China's infrastructure boom and global demand expansion. Markets don't typically choose new realities without economic forces driving supply-demand imbalances. Gold's repeated higher highs since the 1970s reflect inflation cycles, currency debasement, and monetary policy shifts, rather than technical patterns alone. Investors should always connect chart moves to macro drivers before assuming history will repeat. Next, Michael Oliver examines the silver to gold ratio, a key signal metals investors watch closely.
Anyway, I think that not just the prior archival actions of copper and lead, for example, or, look at the price relationship of silver to gold, for example. It's ridiculously low historically. In fact, last year, it was down 1% of the price of gold. Divide an ounce of silver into an ounce of gold. 1%. Okay. If you go back and look at the bull market surge that peaked in 1980, in fact, for a period of time there, not just a spike, it was at 6.5% of the price of gold. Okay. Then in the 2011 bull market, 2010 to 11, the latter part of that bull market, silver was over 3% the price of gold. So last year it was 1%. What do you think? It's going to free? Okay. So it's popped up over 2 recently, breaking out over a massive, clear technical structure on the relative performance chart, meaning an ounce of silver divided into an ounce of gold plotted each month. And you had a very clear ceiling, and it broke through that. So that's yet more evidence that silver is waking up even relative to gold.
Ratios can tell powerful stories, but they can also hide timing risk. Michael Oliver highlights the silver to gold ratio rising from roughly 1% to over 2%, which historically signals improving momentum in silver cycles. Still, ratio expansion alone doesn't guarantee sustained price rallies. In 2011, the ratio peaked just before a multi-year metals downturn. Investors should remember that gold often leads during uncertainty, while silver follows during liquidity expansion phases. The ratio move may signal rotation, but not necessarily a straight-line bull market. Next, Michael Oliver explains why monetary expansion could become the biggest driver for silver prices.
And yes, we had a sharper pullback than gold just recently, but it's still outperforming gold when you go back a year, 6 months, etc. So we favor silver over gold, and we think this is a buying opportunity.
And I'm sorry, your $300 to $500 target, that's quite a wide range, but that's based on a percentage?
Lots of things. First off, let's look at gold, the mama. It's had 2 big bull markets since, well, it got legalized in 75, and it was already at 200, and then it dropped down to near 100 by 76. Okay. From the 76 low to the 1980 high, it had an 8-fold gain. In other words, if you bought gold at the low, you made 8 times your money by 1980. Then it dropped and plateaued at a much higher level than it had been before. And in 2001, it made lows around $260. And it had an 8-fold gain to get to its 2011 peak. Different span of time, 10 years as opposed to about 3, but same dimension move, 8-fold.
The pattern being highlighted here isn't price. It's the repeating magnitude of gold bull markets. Michael Oliver is emphasizing that gold's 2 major modern bull runs delivered roughly 8-fold gains from 1976 to 1980 and again from 2001 to 2011. That historical symmetry matters because it frames current gold strength as potentially mid-cycle rather than late cycle. But investors should remember those rallies coincided with inflation shocks, rate volatility, and currency stress, not just technical momentum. Portfolio risk management still matters when projections rely on historical multiples repeating. Next, Michael Oliver connects gold's potential upside to silver's relative value opportunity.
Okay. We made a bear low at 1,050 in 2015. We're now only 5-fold above that level. And yet everybody says gold's overbought. Heck, it hasn't even matched the performance it provided in the prior 2 bull markets under far less monstrous fundamental factors in play. So even if it just matched the multiple gain of those 2 bull markets, it'd be $8,500. And by the way, we've been saying that for a year, not as a target, but just as a get back to what we've done before type thing. JP Morgan has now come out just recently and come up with the same number. Isn't that cute? Anyway, but if gold went to the 8,500, okay, let's just say, okay, let's say that's all it does, match the prior bull markets. And silver went to 3%. I mean, that's where it was in 2011. Okay. Whoa. What's that, $240, $250, something like that. Okay. I don't have my calculator. If silver went to the levels it was relative to gold in 1979, 1980, it'd be 6-fold above that level.
Calling gold overbought often says more about sentiment than valuation reality. Michael Oliver argues that gold's move since the 2015 low hasn't yet matched prior bull market multiples, which challenges the popular narrative that metals are already overheated. Institutional forecasts, including recent large bank projections, increasingly acknowledge persistent inflation risk and sovereign debt expansion as long-term tailwinds. But investors should remember that ratio-based silver projections depend heavily on gold continuing higher first. If gold stalls, silver's leverage thesis weakens quickly. Next, Michael Oliver shifts the discussion toward money supply expansion and inflation math.
Now, here's another, and that projects up toward the 500 level. Two other factors to look at. One is just simply monetary degradation. Look at an M2 chart. Go back to 1980 or 2011. See where the M2 was then. See where it is now. What's the gain? If silver were to match that gain, it'd be in the several $100s just to be where it was in real buying terms in 1980 or 2011. And there's another thing to look at. A stupid, simple price chart. There's two charts you can look at. One's arithmetic, meaning dollars on the left side. And you've got that 50-year range, and the thickness of that range is like a box, okay? It's a $4 to 50. Let's call it 5 to 50. So it's a $45 thick range. Added to the top of the range, $50. So when it broke out, your quote swing objective, orthodox method, would be $95. Look what happened when silver got up to 93 to 95 a couple weeks ago. There was a fight. There were a lot of sellers there saying, swing objective met. Okay, boy. And they got a little bit of sell-off and then blew their head off, went to 121.
Money supply comparisons sound convincing, but they rarely translate cleanly into price targets. Michael Oliver points to M2 expansion since 1980 and 2011 as justification for higher silver prices. And it's true, US M2 surged dramatically after 2020 stimulus policies. However, liquidity doesn't flow evenly into commodities, and velocity of money matters as much as supply. Investors should also remember that inflation-adjusted commodity pricing depends on industrial demand cycles, not just monetary expansion. Chart projections can suggest direction, but fundamentals determine durability. Next, Michael Oliver introduces logarithmic chart analysis to justify much higher silver projections.
So obviously the arithmetic scale, swing objective, is invalid because we went way beyond it. Okay. But if you put it on a logarithmic ratio scale, just like I was talking about with gold, if you'd put that gold on a log scale, you'd see the eightfold moves of equal dimension on a log scale chart. If you put silver on a logarithmic scale and add it to the top, it says $500. Why? Because the low of that range was $4 or $5. The high was 50. That's a tenfold dimension gain from bottom of range to top. Add tenfold to 50. Okay, enough reasons, right? Okay, and usually these changes in reality where a market says, I did something wrong for a long time, I'm going to adjust it. You have a tantrum. You don't do it incrementally, crawling all your way up. You suddenly burst to correct for the error before. You often will overdo what might be justified. So if, let's say, 250 or 300 is fully justified, then maybe they overshoot it. It's typical of markets that are correcting for excess.
Logarithmic charts can reveal long-term symmetry, but they don't guarantee future outcomes. Michael Oliver's argument relies on proportional moves rather than dollar-based projections, which is a common technique in long-cycle commodity analysis. Still, markets rarely follow geometric projections without confirming macro catalysts like inflation spikes, policy mistakes, or supply shocks. Investors should remember that silver's volatility historically increases near speculative peaks, not just at breakouts. Overshoot scenarios can happen, but they often end with sharp corrections that punish late buyers. Next, Michael Oliver explains why timing within this surge matters more than the ultimate price target.
Anyway, those are some multiple reasons why we still assess that, nope, our assessment months ago, silver going into the hundreds. It's probably going to do it within a couple quarters. This correction occurred when? At the end of the second month of the surge. Surge defined by when silver broke out versus gold on a spread basis. That was the close of November. Okay. January, February, and then it has this correction. Earlier than we expected. We thought we might get one about midway into that 6-month period. But we still think by summer you'll likely be at very high levels.
Now, one of the reasons why I've always had a larger weighting toward gold is because it's a lot more stable. And it's a lot more, the market itself is much larger and it's much more mature. And, to see gold move 10% in either direction is very rare. Whereas silver, we saw it rip it was up 70% in the first few weeks of this year, and then it dropped 30% in one day.
Volatility itself is often the biggest risk signal investors ignore during commodity surges. Michael Oliver acknowledges silver's explosive move, up roughly 70% early in the year before a sudden 30% drop, which highlights how unstable momentum-driven rallies can become. Historically, metals markets entering speculative phases show widening daily ranges and rapid sentiment swings. Gold stability versus silver reflects deeper liquidity and broader institutional participation. For long-term investors, volatility management matters as much as upside potential. Next, Michael Oliver addresses whether this kind of extreme price movement should worry investors.
And to me, that's kind of concerning.
Yeah.
Are you not concerned by that kind of volatility?
Well, yeah, sure. But it's from an investment grade point of view. And I'm even talking investment grade like 6 months, okay? Silver is the place to be by every metric we can measure against gold. And it will likely outperform gold as it has. In fact, if you go back a year, it was 1%. Now it's 2%. That means gold in relative value to gold over a year. So while gold's gone up over the last year since early 25 to the present, silver's more than doubled, despite the pullback, than what gold has done. Yes, with more volatility here, but again, the key issue for investors is what was your point of entry? If your point of entry was finally, oh gosh, I believe it now, I'm going to buy it at 120, okay, well, you got bagged, and maybe you should have been. Our buy levels were last June coming up toward 35, and at the close of November in the 50s.
The real risk here isn't silver's volatility. It's investors confusing late confirmation with smart timing. As Michael Oliver highlights, silver's relative performance versus gold has doubled year over year. But that stat hides a brutal truth about entry discipline. A metal that's up over 100% against gold will punish anyone who waits for headlines or social proof before acting. Buying at 120 after a vertical move isn't investing. It's momentum chasing with poor odds. The June $35 and November $50 levels mattered because liquidity, not emotion, was still dominant then. Volatility didn't create losses here. Impatience did. Next, Michael Oliver explains why timing matters more than conviction in runaway markets.
Those were our last two major buy signal levels. So yeah, we gave back some profits, but on the other hand, nothing alters our assessment. We shall see.
Now, I want to play devil's advocate, and
Okay.
as I mentioned, silver dropped 30% in one day, and the last time we saw a move like this was in 1980,
Yep.
and on March
In the range, yeah.
on March the 27th of 1980, it dropped 63% in one day, and then
Wow.
in the ensuing months, we saw a lot of chop back and forth,
Yeah.
but long story short, it lost 70% of its value. You don't see that happening now?
No, I don't. If this were 6 months into the move, and if silver had reached $400 or $500 or something like that, I think you would have a sharp correction from there, but not back to $50. The old reality's gone. The question now is, where is silver going to define the extreme upper end of the new reality?
The comparison to 1980 sounds scary, but it ignores where we actually are in the cycle. Michael Oliver points out that the infamous 63% one-day crash happened at the end of a multi-year blow-off, not weeks into a structural breakout. Back then, silver had already gone parabolic, and leverage was extreme. Today's correction came barely 2 months after a relative breakout versus gold. A 30% drop feels violent, but context matters. Early cycle corrections reset positioning. They don't end secular moves. Investors should focus less on past collapses and more on whether price has reached exhaustion levels. Up next, Michael Oliver explains how new reality zones form before markets truly peak.
And I think it's going to do it very rapidly, meaning in a handful of months, not 3 years. And I think once it does, it'll probably overshoot and probably collapse from there. If you got in at $400 or 500, the issue is, did you get in at a proper time? And I think happens to be right now is the proper time. You've got to pull back, use the opportunity. And most of our measurements are fairly long term when we analyze markets. We're looking for the big moves. But even when we get down to the micro stuff like daily momentum or weekly momentum, which we included in our weekend report, when we analyze that, we can even see buy trigger levels, of which like daily momentum today is already crossing a buy trigger level. Short-term momentum saying, hey, I'm out of the hole now, okay? The weekly offers a number about $6 above today's high. If you get there this week, next week that'll adjust down some.
What rarely gets said is the parabolic upside creates danger after it rewards discipline, not before. Michael Oliver is blunt here. The real collapse risk belongs to late entrants near $400 to $500, not buyers stepping in during controlled pullbacks. Daily momentum flipping positive, and while weekly levels trail by only a few dollars, tells you institutions are probing again, not fleeing. This is how strong trends rebuild energy. Short-term fear shakes out weak hands while longer-term signals quietly reset. Retail hears overshoot and collapse and panics, but professionals hear sequence, not timing error. Next, Michael Oliver lays out why this pullback may already be doing its job.
So even the short-term stuff is saying, hey, I'm out of the hole, okay? So at that point, I would say if you're not in silver, join in. Yeah, you're buying it off the low, recent low, but you're buying it well below the recent high. So view it as an opportunity. Nothing has broken other than public sentiment. And I argue that the drop you saw then in 1980, for example, yes, that was top of the old range. Silver just gone from like what, $5 to 50. And it had a four-fold move in the last 5 months of that explosion. I'm talking 2 quarters roughly. In 2010 and 11, it was a 7-month explosion, which doubled in half the price of silver in 7 months. Both of those surge events, still caught in that old range though, were triggered by the spread breakout of silver versus gold, where you could plot the relative performance chart and you could draw a line with a crayon and say, if you get above that line, you're breaking out over a multi-year base.
This is the part Wall Street glosses over. Sentiment breaks long before structure does. Michael Oliver emphasizes that nothing technical has failed. Only confidence has. In both 1980 and 2011, silver's explosive runs occurred inside an old range, making them vulnerable to violent reversals. Today's move followed a clean, multi-year relative breakout versus gold, which historically changes duration and magnitude. Buying below the highs after sentiment damage is how institutions build positions quietly. The crowd waits for comfort. Capital moves when doubt is loudest. Next, Michael Oliver explains why range breakouts matter more than price speed.
And when it did, it had a tantrum. We did the same thing, except even a bigger and clearer base, silver relative to gold, at the close of November. So it's only 2 months and 2 weeks now into a likely couple quarter surge.
Well, that's, as always, Michael, this has been an interesting discussion. I want to thank you very much for spending time with us today. And I guess your message that you really want to convey to investors is that get long gold and get long silver.
And they're miners. My preference right now, personal investments are, I favor silver over gold vastly, despite the recent drop. And I favor the gold and silver miners over gold as well. They have not broken out yet versus gold. They have firmed nicely over the last couple of years. The miners have beat gold, but they've been still stuck in a range of performance readings that they've been in for 11 years at very, very low valuation levels. They're challenging the upper end of that range. If they break out, you're going to get a gusher in the miners. And I suspect we're going to see it this year.
The overlooked signal here isn't silver. It's the miners quietly coiling beneath a decade-long ceiling. Michael Oliver notes that silver's surge is barely 10 weeks old, yet miners remain trapped in an 11-year valuation range despite beating gold recently. That divergence tells you leverage hasn't been priced in yet. Historically, miners lag early, then violently catch up once metals confirm sustainability. If that relative breakout occurs, capital rotation could be fast and unforgiving for underexposed portfolios. This is where asymmetric risk quietly builds.